In corporate accounting, we are going to discuss about valuation of goodwill and shares. First, we will see the meaning of goodwill. Goodwill arises when a company acquires another entire business. The amount of goodwill is the cost to purchase the business minus the fair market value of the tangible assets, the intangible asset that can be identified, and the liabilities obtained in the purchase. Definition of goodwill. According to the Institute of Chartered Accountants of India, goodwill is an intangible asset arising from business connections or trade name or a reputation of an enterprise. Next, we see the need for valuation of goodwill. Valuation of goodwill may be made due to any one of the following reasons. In the case of sole proprietorship firm, if the firm is said to another person, if it takes any person as a partner, and if it is converted into a company. In the case of a partnership firm, if any new partner is taken, if any old partner retired from the firm, if there is any change, if different partnership firms are amalgamated, if any firm is sold, and if any firm is converted into a company. In the case of a company, if the goodwill has already been written off in the past, but the value of the same is to be recorded further in the books of account. If an existing company is being taken with or amalgamated with another existing company, if the stock exchange quotation of the value of shares of the company is not available in order to compute gift tax, wealth tax, etc., and if the shares are valued on the basis of intrinsic values, market value, or fair value methods. We can see now the factors affecting the value of goodwill. First factors, locational factor. If the firm is centrally located or located in a very prominent place, it can attract more customers, resulting in any increase in turnover. Therefore, locational factors should always be considered while ascertaining the value of goodwill. The next one, time factors. Time dimension is another factor which influences the value of goodwill. The comparatively old firm will enjoy more commercial reputation than the other one, since the old one is better known to its customers, although both of them may have the same locational advantages. Nature of business. This is another factor which also influences the value of goodwill, which includes the nature of goods, risk involved, monopolistic nature of business, benefit of patent and trademarks, and easy access of raw material, etc. Capital required. More buyers may be interested to purchase a business which require comparatively small amount of capital, but rate of earning profit is high and consequently raise the value of goodwill. On the contrary, for a business which required a large amount of capital, but the rate of earning profit is comparatively less, no buyer will be interested to have the business, and hence goodwill of the said firm is pulled down. Trend of profit. Value of goodwill may also be affected due to the fluctuation in the amount of profit, that is, on the basis of rate of return. If the trend of profit is always rising, no doubt value of goodwill will be high, and vice versa. Efficiency of management. The efficiency management may also help to increase the value of goodwill by increasing profit through proper planned production, distribution, and services. Therefore, in order to ascertain the value of goodwill, it must be noted that such efficiency in management must not be curtailed. Other factors: condition of the money market, possibility of competition, government policy, and peace and security in the country. Method of valuing goodwill. First method, year's purchase of average profit method. Under this method, average profit of the last few years is multiplied by one or more number of years in order to ascertain the value of goodwill of the firm. How many years profit should be taken for calculating average, and the said average should be multiplied by how many number of years? Both depend on the opinion of the parties concerned. The average profit, which is multiplied by the number of years for ascertaining the value of goodwill, is known as years purchase. It is also called purchase of past profit method or average profit basis method. The formula for profit basis method: average profit equal to total profit for all the years divided by number of years. Value of goodwill equal to average profit into number of years of purchase. Second one, years purchase of weighted average profit method. This method is a modified version of year of purchase of average profit method. Under this method, each and every year profit should be multiplied by the respective number of weight. Example 1, 2, 3, etc. in order to find out the value of product, which is again to be divided by the total number of weight for ascertaining the weighted average profit. Therefore, the weighted average profit is multiplied by the years purchase in order to ascertain the value of goodwill. This method is particularly applicable where the trend of profit is rising. So, the formula for weighted average profit equal to total profit for all the years divided by number of years. Then capitalization method. Under this method, the value of the entire business is determined on the basis of normal profit. Goodwill is taken as a difference between the value of the business minus net tangible asset. Under this method, the following steps should be taken into consideration for ascertaining the amount of goodwill. Expected average net profit should be ascertained. Capitalized value of profit is to be calculated on the basis of normal rate of return. Net tangible asset, that is total tangible asset minus current liabilities, should also be calculated. To deduct third from 2 in order to ascertain the value of goodwill. Capitalized value of profit minus profit, that is adjusted, divided by normal rate of return into 100. So value of goodwill equal to capitalized value of profit minus net tangible assets. Then next one, annuity method. Under this method, super profit, that is excess of actual profit over normal profit, is being considered as a value of annuity over a certain number of years, and for this purpose compound interest is calculated at a certain respective percentage. The present value of the said annuity will be the value of goodwill. Value of goodwill B equal to present value of annuity, A equal to annual super profit, N equal to number of years, I equal to rate of interest. Then we go for the super profit method. Super profit represents the difference between the average profit earned by the business and the normal profit on the basis of normal rate of return for representative firms in the industry. That is, the firm's anticipated excess earnings. As such, if there is no anticipated excess earning or normal earnings, there will be no goodwill. This method is used for calculating goodwill depends on normal rate of return of the representative firm, value of capital employed divided by average capital employed, and the estimated future profit, that is the average profit of the last few years. Super profit equal to average profit adjusted minus normal profit. Value of goodwill equal to super profit into number of years of purchase. Then we go to the share. Meaning of share. First we will see the meaning of share. Shares are unit of ownership, interest in a corporation or financial asset for an equal distribution in any profit, if any are declared in the form of dividend. Definition of share. A share is referred to as a unit of ownership which represents an equal proportion of a company's capital. A share entitles the shareholders to an equal claim on profit and losses of the company. Then need for share valuation. The necessary for valuation of share arises in the following circumstances: for estate duty and wealth tax purposes, for amalgamation and absorption schemes, for gift tax purposes, for discharge of debt and liabilities in exceptional nature, then purchasing shares for control, for selling shares of a shareholders to a purchase which are not quoted in the stock exchange, for the conversion of one share one class of share into another class for the compensation made by a company when the said company is being nationalized. Then for granting loans on the basis of security of shares, that is when the shares are held as security, etc. Then we see the factors affecting the value of shares: the nature of the company business, the economic condition of the country, other political and economic factors, that is possibilities of nationalization, excise duty on goods produced, etc. The demand and supply of shares, proportion of liabilities and capital, rate of proposed dividend and the past profit of the company, yield of other related shares of the stock exchange, etc.